Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And this morning I was thinking, sometimes an investor and a trader feels like they've earned their bragging rights just by breaking even. 2026 has been that kind of a year. Sometimes we feel like kind of shouting from the rooftops, look at me, I'm breaking even. I've treaded water over the last several months. I think we want to talk today about how income strategies can sometimes keep a portfolio afloat when those stock market waters get kind of choppy. So I think this is going to be an interesting discussion. Before we get to the details, before we add a new position to our portfolio, let me first of all say hello to everybody who's already out there chatting in. Great to see all the familiar names. Hello to anybody who might be new, but hello there, JB Texan and Scott, Mark, Simone, John, Kevin, Jack, Will, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I do want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. That's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, as a great treat for my my live stream audience members, my great friend Scott Thompson is hanging out in the chats with us today. Scott's keeping an eye on the questions that come in, and if I can't get to those, Scott's going to be there to pick up my slack for me. So thanks for having my back, Scott. Scott and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find Scott there at Scott Thompson CS. You can find me. Now, specifically when I say there, I mean on X. You can find Scott on X at Scott Thompson CS. You can find me on X at Cameron May CS, and you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion. Sometimes, it's a victory to break even. And we're going to talk about how income strategies might contribute to that and how they have contributed to that in our example portfolio. But as we do, of course, there are risks associated with trading and investing, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. And any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be doing today. We're going to take a quick look at the markets just to see what we've been dealing with since the start of 2026. I also want to take a look at what the rest of 2026 may hold in store. We don't know. Nobody has a perfect insight. We're going to be looking at a couple of charts that might assist with that effort. Then we're going to use that to set the stage of how for some traders, some investors, they feel like they've really accomplished something just breaking even at some times. And I want to show you in our paper money portfolio how that's what's going on at the moment and how it might be something to be celebrated, right? Now, then we're going to move into a discussion of maybe adding a new position to that paper money portfolio and talk through the pros and the cons of that. We're going to be, for today's trade, going to be doing a short put, all right? But let's get right into this. Let's go right to the thinkorswim desktop. This is the simulated trading environment known as paper money. And we're going to review the S&P 500. So, Ricebird, you say the scan issue's resolved itself, but you're thanking me. Give me credit for it. That you're welcome. It had nothing to do with it. But here's the transition point from 2025 to 2026. This is where we started the year. And you can see how for the first couple of months, let me go to the right spot there. First couple of months, we really didn't accomplish much right through there. Markets chopping up and down and up and down and up and down. The markets, meaning here's the S&P as a stand-in for stocks in general. But then this last month has been kind of particularly sour. You can see we've sold off down to lows, getting a little bit of a bounce here, maybe off of these previous price floors. We'll see if that continues. But it's been a bit of a frustrating ride for 2026 for stock investors. So I'm going to use that as a backdrop for what's going on in our paper money portfolio. But there's an important insight that may not be obvious as we go to the monitor page that I want to call attention to. But just bear that in mind. From here, though, where might stocks be headed? We don't know for sure. But let's say that we are an income investor trying to make that decision. Is it still Do market conditions still seem to be aligning with bullish portfolio positions, or should we maybe start to scale back? And there's a little bit of evidence here that maybe we're coming off a price floor. Let's see if that's what happens. Let's say that our investor here is starting to suspect that maybe we start to move back toward highs. Time will tell, but I wanted to give some additional context here. I think it was last Thursday, we had a discussion about some tools that might assist in gaining longer-term perspectives on stock charts and on market charts. And one of those tools is the seasonality chart on thinkorswim. So let me load that up here. I'm going to go to the chart style. Right now we're just looking at a traditional standard candlestick chart. So let's switch the chart mode from standard to seasonality. There we go. And if you haven't seen this seasonality chart before, by default it's going to be showing this. The green line is showing us how the S&P in this case has done since the start of the year. So there's the box that I drew. There are those lines. Then we have this red line, which is just showing us how last year went. So we can do a little bit of a comparison. Looks like last year got off to a little bit better start, turned right about the same time though, and started to struggle. So kind of mirroring last year to some extent. But this is interesting what happened last year. And actually, this is also reflective of what's happened much of the time over the last 20 years. I want to get a longer term perspective here. So I'm going to switch the time frame up here to a 20-year one-day chart. And now this red line isn't showing us last year. It's showing us the average performance of a year from January to December over the last 20 years. But it's kind of compressed down at the bottom. So to zoom in on that, I'm going to use my chart tool up here in the upper right. I'm going to change that to manual, which is going to allow me to zoom in, click and drag downward to zoom in on just that average price performance chart. So if you're not familiar with this tool, this is a seasonality tool. It's looking at sort of how the seasons have gone on average over the selected time frame, and we're looking at 20 years. So we can see that an average year over the last 20 has started off pretty well. 2026 was kind of flat. Then as we move toward March, we pull back, much like we've seen in 2025 and also now in 2026. But where have things typically headed from here? Right now, as of the recording of this session, it's March 23rd. So if we orient ourselves right on March 23rd, where is that? That's going to be right there. Where have things gone as we move through the rest of spring and into sort of the middle of summer? Actually, an average year has delivered about a 7% return on the S&P 500 over the last 20 years. Is this Coach Cameron saying guaranteed 7% over the next several months? Nope. But for some, it might be important to sort of gain context with, we know how things have gone. How have they tended to go in the past? Could that be some insight into what this year holds? Maybe. We'll see. Now, after that, though, moving from the third week of July, it's typically been pretty flat until about the third week of maybe October. But for now, let's say that our income investor has been sort of treading water, which is an accomplishment given the performance of 2026, but maybe they think things are going to brighten up here. Time will tell. Let's switch up our chart though. Let's switch first of all back to the 1-year chart, then we'll switch our style back to the standard chart. And now that we have that as that backdrop, I think you can see a case. Let's just say that our income investor is still looking kind of bullish. And so they're going to still continue to consider strategies like covered calls or short puts, both of which are bullish income strategies. But I want to go look to see how our example portfolio is doing. Right now, over the course of this last week, we had one position that closed up, and then we have 5 current positions. That one position actually closed up profitably. It was a Johnson & Johnson short put. So just to quickly show you that one. We sold the 20th of March 235 put. This one was close, I'll tell you. As we got toward that 20th of March expiration, where did we close on Friday? So this just expired on Friday. 235.37, 37 cents above our strike. Pretty well selected. But this one just expired, worthless, which was good. Worthless is what we were shooting for. We were not assigned that just resulted in a $1.89 profit per share, or in other words, $189 profit. Now, I'm going to set that aside. That was nice, great to see. But how are our current positions going? Well, if we tally them all up right now, not going so well. Right now, we just have 4 covered calls, and then we have a long stock position that was previously a covered call. So this looks like, just like most stock portfolios out there in the markets, I have to say most, that's kind of a guess, but just using the indices as an estimation of how most stock portfolios are doing, probably most have been going down for 2026. And this one doesn't seem to be an exception. Current positions down about $6,400. Now, what is not reflected in this is the income that's already been secured, obviously just paper trades, but we have some realized income gains on these positions. I'm not counting any other previous positions that had previously closed profitably. That would be sort of inflating the numbers. But just on our Apple, AbbVie, Amazon, Nvidia, and Walmart stocks, we actually have a running tally of realized income gains of over $6,600. You net that against right now, down about $6,400 on the remaining positions. And actually, it's a break-even scenario for well, rather than saying for 2026, for this portfolio as currently constructed. Actually, the portfolio has done even a little bit better than that for 2026, if we include other unrelated positions. So I think it's an important story to tell for the income investor. There is a benefit there that can kind of slide to the side, kind of go unnoticed, and that is a portfolio that can appear to be struggling may actually be doing just fine if we include all the income that's been delivered over the years or over the months or however long we've been in the position. So with each of these, we'll look at the history. But let's start with Apple. Some of these we need to maybe take some action on before we add a new position. But let's look at the history first. Let's look at Apple. So here's the history of our Apple position. It started off with selling some puts. Those just expired for a profit. Sold some more puts. Those were assigned. So we have some income that's already been realized, but now we own the shares. Once we own those shares, we started selling calls. Initial calls sold and closed for a 220 profit. Some more calls sold and closed for a 229 profit. Right now, we're in the 275 calls for the 17th of April. Originally collected 268, but those positions were taken right here, and the stock has pulled back a little bit. So we'll see how those calls are doing. Let's see if we need to do anything with those. Let's go to Apple. Sold those calls for 268. Right now, we might be able to exit, close those out for just 45 cents. So we may be in position to add to that running tally of realized gains. I think, though, with Apple, with 25 days left till expiration, I want to leave this one in place. That's a decision that I'm making. For some traders, they might say, hey, good enough. Let's close this out. Let's see if we can realize $2.20, maybe $2.23, somewhere in that neighborhood. If we close that out and then maybe sell another call, roll to a more distant expiration, possibly lower the strike. But with this one, I think we're going to leave that alone. Now, AbbVie, though, this one, we're in 200 shares. The current position is a 240 call expiring the 17th of April. We collected $1.70 for this. It's only worth 19 cents. But I need to go, we're going to look at the history, but also talk about the plan that we wanted to discuss if we got to where we are right now. So the history of this is we just bought 200 shares for $227.18, sold some calls, made a profit on those, sold some calls, made a profit on those, sold some calls, made a profit on those, sold some more calls right here. So that was this day. We sold the 240 strike again, and we've crashed. We've come out, Mark's saying, yeah, let's talk about ABBV. Here's the decision that we might need to make, even with all of these premiums that we've collected, realized gains, even with this dividend that was collected. We add all that in, we're still below break even. This is not a position that has managed to tread water. We're underwater on this one. And I wanted to talk with you about, Mark says, I think it might be time, just stick with a plan with ABBV. These are the hard decisions that an investor or a trader might need to make. And the plan with this one was there was an apparent price ceiling here that we suspected may act as a good price floor, and it doesn't look like it has. And even today, with a little rally that we're getting on the markets, AbbVie not participating in that. So Mark, you think we ought to wrap it up? I think that's consistent with the plan. A little bit earlier today, I was wondering, it was starting to rally. At one point, we were right up near that floor. And I wondered by the time I launched this webcast, if maybe we could sneak back up above that floor. It might change the scenario, but even in the course of an hour or two, things can change. I think I agree with you there, Mark. Let's stick to the plan with AbbVie. We're going to be closing out these 200 shares, closing out that covered call, just taking our lumps on this one. So let's right click. Let's create a closing order and just sell the whole position. If we choose the top item here, it's going to close out the entire position, sell the shares that we're in, buy back the calls that we are short, and we might be able to get out for a credit somewhere between 204 and a quarter, 204.40. How about let's see if we can get 204. What do we think? 204 and a quarter. That would be the net cost that we're trying to retrieve. I shouldn't say net cost, net credit between closing out the shares and buying back the calls. So let's see if we can get out for at least that, a 204.25 credit. We're going to click confirm and send. Going to sell out of this covered call, trying to sell the shares, buy the calls back. It'll give us max profit, max loss, but this is a closing transaction. We don't care about this. But there are commissions to be paid in closing out those two calls, so we need to be aware of that. That can chip away the net credit retrieved for the portfolio down to a little bit under $41,000. And let's send that off. Let's see if that can fill. So right now we're asking 204.25. Mark is 204.32. I was going to say, I think this is going to fill, and it did. So with that one, Andrew says, what's your target for profit or loss? And Andrew, when we're getting into a position where we own shares and we're selling calls again and again and again, we don't know exactly what that net profit might be. We kind of have to deal with the premiums that are available at the time we choose to sell them. And then I will say that frequently, if we're able to exit with 80 or 90% of the original premium that was collected, if we can still keep that, you'll commonly see me exit at those levels. That's just an example. It's not saying it's the only way that it can be done. For some investors, they prefer to hold right up to the end. It's up to them. But for the stocks, we'll typically hold as long as they appear to be behaving bullishly. If we start to break down through support levels, for some traders or investors, they pull the plug at that point. So that's what you'll probably see me do here. Okay, but Amazon. This one, we just own 100 shares. Those 100 shares, not doing well, but we have collected income along the way. So we need to decide what to do with these Amazon shares. So let's go to Amazon. With this has quite a history. Sold some puts back here for 370. We closed out one of those contracts for a 303 profit. We closed out a second contract for a 365 profit. All of these historical trades, if you want to see them start to finish, they were all done on camera, so you can just go to the archives. Let me show you that. If you go to our YouTube channel, Trader Talks Schwab Coaching Webcast is the channel name. And if you haven't subscribed, by the way, pop down, click on the subscribe button right now. It doesn't cost anything. It only takes a second to do that. But this is where you can join the live streams, but you can also find the playlists of previous discussions. So if I go to the playlist here, and I just scroll down, it's kind of toward the bottom for this webcast series. Go down here to covered calls and short puts. You click on view full playlists, and you can see the management of all those previous positions right there. All right, but let's go back here. So we closed those two puts out for a profit. Then we sold some more puts. Those were assigned. So we wound up buying the shares at 235. And the stock, this one, has also taken some lumps. We're a little bit underwater on this position overall. Break even's at 223.97. We closed out 100 of our 200 shares. So right now we're just left with the 100 shares. A little bit below break even. The plan here was, well, we're going to sell the remaining shares if that support broke right down around 195 or 197. It hasn't broken yet. So I think what we'll do here is let's sell another call. I wonder if we can get one up above break even. If we sell a strike above our break even, then we're obligated to sell our shares only if they've climbed back up above break even. Let's see. Let's see if we can get what we can get for maybe the 225 strike for April. I haven't looked yet, but let's go have a look. There's the 17th of April. Let's look at the 225 strike, and it looks like about $1.67, a shade less than 1% for a 25-day contract. That's about what that works out to be. I think that's the one that we'll do for today. So let's click on that bid price, and we're just going to sell one contract since we just have 100 shares remaining. And it looks like the natural is 167, the mid, it's pretty tight spread on Amazon. It's a pretty liquid stock. So how about we just stay there? I might even back down if this feels completely unnatural to you. I'm just doing this to try to get as quick a fill as possible while conducting a webcast where time is of the essence. But let's say that we're willing to settle for as little as $1.65 on that call. And let's confirm and send that order, even though that's a little bit of, it's even less than the natural. Trying to sell for 165. There is a commission to be paid, so that would leave us a net credit of $164.35. And let's send that order off and see if we can get that filled. Yeah, it filled at 169. Just because I put in a limit order at 165 doesn't mean I have to accept 165. If there's more available, we might collect more, and that's what we did. So there we go. So for the next, see, here we are today. Let's draw in a line up here at 225. Carry that out to the April expiration, right about there, close enough. That just shows you where our cap now is on our stock. Someone has the right to buy those shares from us for $235. That's above our break even. As a matter of fact, with the $1.69 that we just collected in premium, we've lowered that break even by $1.69. So it's actually down closer to 222 at this point. 222 and maybe 30 cents, something like that. All right, so we're done with that position. Let's look at Nvidia. And with Nvidia, own 100 shares. We've sold the 195 call for the 17th of April. And that call we sold for 420, it's only worth 74 cents. So maybe we can get out and realize $3 and maybe 45 cents worth of gain. Maybe. Let's go have a look at the chart again. There's the history of our Nvidia position. We bought 100 shares, and then we've sold some calls. Sold November calls, made a profit, sold December calls, made a profit, sold January calls, made a profit, sold February calls, made a profit, sold March calls, made a profit. Now we've sold April calls, and our plan here was to consider exiting if support breaks, and it looks like the support is holding again. So what was there, 45 cents left in these? No, 75 cents. I think with this one, I'm going to let this one continue to work. 25 days till expiration. We could close this, very likely. I can't ever guarantee it, but likely could close this for about 80% of that original credit, and maybe sell another one. But I think this one, we're going to let it work for one more week. And that brings us finally to our Walmart position. 100 shares, we've sold the 10th of April contracts at the 132 strike, collected $1.11. Those were only worth 20 cents. Again, looking like we could maybe exit for a little bit more than 80% of that original credit. But let's go see what Walmart is doing. So with Walmart, this one, so Mark, we were looking at AbbVie. Everyone else, we were looking at AbbVie, and it had kind of more decidedly broken down through that support. Here's what's going on with Walmart. We bought some shares way back in the day, didn't really do anything with those, just watched them go up. But very recently we sold a call, which we closed for $1.33 profit, sold another call for 111. That's up there at that 132 strike. We pulled away from that. So that's brought the cost of that call way down. But in pulling away, we're teasing with this support. Yeah, Mark says you already got 80% of your Walmart. Yep, we might roll this one out. I'm not sure. But first of all, we got to decide, do we keep the shares? Because had we met on Friday, I think there'd be a strong case that we'd broken support. At this point, we're right there against it. What do we think? I want to throw it out to my audience. Is this far enough below support that your vote would be to close it up, or do you think we should hold it and roll it? So here are the two options for you. Exit means get out, or roll, keep the stock, sell another call. What do you think? I'll wait for some votes to come in. As soon as I have 3 votes for either exit or roll, then that's what we'll do for the management of this for this position. Obviously, there are pros and cons to both of those decisions. If we keep the shares and they collapse, we got to pay the consequences. If we close and then we rally, we could be making more money. All right, so I had, looks like Wiley said close. Mark had a hold and roll, and then 3 votes came in for exit. So we're going to close this one up. All right, so this one's done. This is going to be closed out profitably. Walmart has done well. It's collected a little income along the way. We're probably going to wind up realizing somewhere in the neighborhood of 90 cents on the most recent option. Yep, so probably somewhere around there. But I'm just going to right click on Walmart and create a closing order and close that thing out. Selling that covered position, selling the shares, buying back the call. Looks like our naturals at 120.53. Again, just in the interest of trying to get this closed out while the camera's rolling, well, I'm going to put that at 120.50 cents, sacrificing potentially a few cents in the interest of closing this up quickly. But I'm going to click confirm and send, selling out of this covered call. There is a commission to be paid on this trade, but let's send this order off and see if we can fill that. And we immediately did fill it, 120.59. All right, so that one's done. So it's going to leave us with 3 current positions. We're going to have something to talk about in the coming weeks, but let's add to this. Barbara says, how do you choose? That's a good question, Barbara. So I started to hint at the decisions that were on the table, right, with Walmart. Well, here's probably the driving factor in this stock. The income is what we've been focusing on for this discussion, how it's managed to help our portfolio tread water in kind of difficult market environments. But if those market environments get worse, can we lose more on the stock or make more on the options? We can definitely lose more on the stock. So the one thing that may tilt the scales for some investors is if they've lost confidence in their stock, because a stock can lose money much faster and to a much larger extent than the income collected. So that, I think, may be the most direct way to answer that question. Now, just because we made the decision, does it mean we've made the right one? That's a story that time will tell, and we probably won't know, because I'm not going to come back and look at this Walmart position now that we've closed it. But if you want to, you can keep an eye on it, see whether we did the right thing in the future. But let's add a new position to our portfolio. We've managed our existing positions. We have some covered calls, so let's do a short put. Short put, covered call, both income strategies, both are bullish. So they're appropriate for someone seeking income who's comfortable with options and who thinks the markets are bullish. All right. Now, I'm not saying that everybody should be doing them. We need to know the pros and the cons of the strategies that we employ in our self-directed portfolio. But we've already seen the markets as a backdrop. Let's just suppose, well, I don't mind. Let's quickly revisit. Here's the S&P. Let's say that we think that our investor thinks that stocks are likely to go up. We also saw the seasonality chart where it seems to be kind of a bullish time of the year, heading toward late spring into early summer. So let's do a bullish income strategy. So what kinds of stocks might a trader be looking for? Well, an income investor or trader, one common priority is the liquidity of the stock. Illiquid stocks tend to have illiquid options and they can be hard to trade profitably. Another priority might be the price of the stock, because to do covered calls, we got to buy 100 shares for most stocks and for most standard standard contracts. Same deal applies for puts, especially if we're doing them in a cash account. We're not buying the stock, but we're taking on the obligation to maybe have to buy the stock. So price of the stock can definitely play a role. But another thing is just what's going on with the stock chart. So I want to look at an example. Short putts. I catch that, Mike. Yeah. He says short putts are my favorite. He says deliberately. Anyway, let's go look at Broadcom. Broadcom, one of the biggest companies in the world. It's a $322 stock. So whether we're buying the stock or we're getting into a contract where we might have to buy the stock, we're looking at about a $32,000 obligation here, right? Now, here's something that what some Broadcom investors and income seekers might note is the stock has been choppy, very reminiscent of what we've seen on a lot of stocks, but it's done a pretty good job of holding above about that 310 level. So how about we do an income strategy through April 17th, where we stand to benefit as long as the stock stays up there above 310. Right now it's 322. How about we do, let's see what we can get for a $300 put, right about there, out through April 17th. So I'm going to go to the trade tab, and let's look at the 17th of April. And that $300 put is trading between 655 and 685. So this is going to be our example trade. It's our addition to the portfolio today. We're going to do a short put. And in this case, we're going to sell the 17th of April $300 put. And it looks like we might be collecting around 670. I don't know if and until this order fills exactly what we'll be collecting. I do love your dumb dad jokes, Mike, because you better believe I heap them on my adult children at every opportunity. Yep. All right, but here's precisely what an income investor might be getting out of this position, and precisely what they need to be prepared for, right? What do they get out of this? Well, somebody is paying us $670. We'll see what exactly we get in just a moment. In exchange for that $670, that other trader has the right to sell 100 shares of Broadcom to us for $300 per share. That's what we're agreeing to. It's a contract. We're getting paid $670 to get into this contract. If those shares happen to collapse in value, that can get ugly. So that's why we prefer for those shares to stay up rather than come down. If the shares stay up here above 310, there is little motivation for someone to decide, even if they have the contractual right to sell those shares to us for 300. So maybe we just get to April 17th, the shares are still above 310. The other party in this transaction says, Cameron, I'm keeping my shares. You keep my $670. That's the outcome that the income investor is probably seeking here. Now, if the stock happens to come down, or if for whatever reason the contract gets assigned, what we may need to decide to do at that time is, do we keep the shares and start to sell covered calls on those, or do we sell those shares for what we can get for them? And that could certainly be under $300. So that's what we need to be prepared for. But that's the income that's on offer for this trade right now. So let's do it. Let's go to the trade tab. Let's go to the 300 strike, and I'm going to click on the bid price. Each contract we do is an obligation to maybe have to buy 100 shares of the stock. So that's a $32,000-ish obligation. Let's just do one contract for this example position. The 17th of April, $300 put. Looks like it's trading now between 660 and 670. So we're maybe not going to get the 670 that I was first talking about. Let's see if we can get at least 660 though. So I'm going to leave that in as my limit. Let's lock that in. And look at this. It just jumped on us. Probably not even going to get that. This put is dropping in value. Why is it dropping in value? Probably because the stock is going up in value. So it's doing what we hoped. We're just not in the trade yet. I'd have to back off on this requirement. Let's say 640. James says, why not sell a put vertical? Or put vertical as to play on the other joke. Because this webcast series isn't called vertical spreads. It's called covered calls and short puts. But I'm not making the argument at all that that wouldn't be an appropriate position for some. I just don't do verticals in this webcast series. So let's click confirm and send. And look at this. Price dropped on us again. We're chasing it. That's what happens. That means our stock price is going up. Awesome. Had we gotten in 3 minutes ago, but we're not in. Anyway, I did not get 640. Let's go for 630. Let's click confirm and send. Get this done. Attempting to sell the $300 put for the 17th of April for at least $630. That gives us that credit minus the commission, a net credit of a minimum of $629.35 if the order fills. But be aware, this is obligating us to maybe have to buy some shares at 32 or 320. What do we choose? $300 per share. Yeah, there we go. So there is risk exposure if those shares collapse to zero. Ouch. Yep, somebody says this assumes you have 30 grand of buying power. I do in this example portfolio. That's why we pay attention to the price per share. But let's send this order off. Let's see if we can get that 630. That looks like we might be able to pull that off. There it is. We got 635. Okay, good. So we didn't get the 670 that we were planning for. We actually got 635. That's because if we go back to our chart, price is strengthening on the stock. Okay. He says, don't chase. It ain't worth it. Just say you got to choose in advance. Well, at the very least, it's kind of like if you go to an auction, right? And you have that item that you really want, you probably want to set a price in your head. What's the most I would want to pay for that item? In the case of selling an option for some income, well, for the obligation that we're taking upon ourselves, what's the least I might accept? We make that decision in advance, set that as our limit price, and then we see if we can get it. Very good. So now we're in an obligation. We might have to buy the shares for $300 per share. When might a trader decide, this isn't working? I'm going to pull the plug on this. If it's going fine, if it's going up, great, let it go. If the stock starts to collapse, though, one way that I think a lot of traders will consider this is, even though we don't own the shares, we have an obligation hanging out there that makes us, we might have to own the shares. So if we get to a point where we would prefer to not own the shares now, this is not going well, that might be when we decide, pull the plug on the trade, even if we're taking a loss, close it out. Okay. All right. So that'll do it. Guys, we've actually accomplished what I set out to do today. We're going to follow up on this position in a future discussion. But today I wanted to talk through how income strategies can sometimes help a portfolio stay above water, even when the markets get choppy. So I can't say it's been a fabulous year for this portfolio, but breaking even is an accomplishment when most other portfolios have taken a step backward. So we'll see how things move from here. Obviously, we still have a bullish bias. We do not want things to continue selling. The income can only go so far in compensating for capital depreciation on our stock, but so far so good, I should say. But guys, we've talked through it. We looked at current market conditions, discussed how income can, in some circumstances, help a portfolio stay afloat when markets get choppy. And we actually even added a new position to the portfolio. So this is what we do on Mondays. We'll follow up next Monday on these positions, make additional trade management decisions at that time. But I have other webcasts between now and next Monday. So I have some suggestions for you to get the most out of Schwab education. Number one is that if you're new to the channel, welcome. It's great to have you, but make sure that you're subscribed to Trader Talk's Schwab Coaching Webcast. That's our channel on YouTube. You can click the subscribe button right down below the video right now. It doesn't cost anything to do that. It only takes a second. You just click it and you're done. But this is where you can join our live streams like the one that I'm hosting right now with Scott's help. And you can also find our playlist for previous webcasts right there. Now, another thing that Scott and I would suggest you do is to follow your favorite Schwab presenters on social media. So you can find Scott and me on X. You can find Scott there on X at Scott Thompson CS. You can find me on X at Cameron May CS. So here I am. This is the guy you're looking for. There's my profile photo. That's my handle, at Cameron May CS. Very active here, and if you read one of my posts, you like it, and you reply to it, you make a comment, I just reply right back to you, and it allows for interaction when the camera's not on. Now, you can also find and follow me and have some interaction on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. All right. Everybody, thanks for giving me your time today. I'm going to let you go. Go enjoy the rest of our webcast through the rest of today. Also, you're certainly invited to join me in my webcasts. As long as the markets are open, as long as I'm not taking a day off, I'm here delivering a webcast of one type or another. So I'll look for you in tomorrow's webcast. But I'll look for you on social media as well, on X and on LinkedIn. Guys, thanks for all of the likes. There are 163 people watching the live stream right now, and I can see 50 of you have already clicked that thumbs up. That helps. I don't know if you knew that, but every time you click the thumbs up button, it gives a nice little, it's like applause to your presenter. That's fabulous. But it also gives my video a boost in the YouTube algorithm. Lets YouTube know that this is good stuff, and it helps more people find these discussions. So thanks for always clicking the like button. And that's true for whether you're watching live or even if you're watching on the archive. Your vote counts just as much. So yeah, click on that like button. Everybody, go have a great day. I will see you in a future webcast. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Goodbye.